Hi, my name is Akhil Mittal. I worked in the investment team of Tata Mutual Fund. I'm a senior fund manager in the fixed income department. I handle a few funds, Tata Treasury Advantage, Tata Gilt Securities, Tata Floating Rate Fund, and the debt portion of Tata Balanced Advantage Fund. So speaking about fixed income, the market is more impacted and more influenced by macroeconomics as against micro or bottom-up cases. So today we will start with discussing a little bit about macroeconomic backdrop in which we are currently operating, and from there on we will discuss a little bit about the funds. So on the domestic front, growth inflation mix has been quite comforting in the sense that inflation has continued to remain substantially below RBI's medium term target and growth momentum continues to be stable. And going ahead also, I think growth will continue to maintain its momentum, albeit slightly slower pace. I expect inflation to continue surprising on the downside as against RBI's projections, which means space will exist for monetary easing for RBI to support growth. There has been a little bit of volatility in the currency market of late, but I think going ahead, impending trade deal with the US should unfold and that should give a certain amount of respite and stability to the currency markets. Once currency markets stabilize, I think we will have flows from FPIs coming back to Indian markets. This will also make life slightly easier for RBI to manage both liquidity and rates. On liquidity front, RBI has already committed that they will maintain sufficiently ample liquidity in the system. I think going ahead in the month of Jan, Feb, March, we will see both OMO purchases and dollar swaps being done by RBI. My sense is dollar swap around 10 to 20 billion, anywhere in that range, and OMO purchases of close to 2 trillion. That is, which will, number one, provide durable liquidity in the system, and number two, also help reduce the rate volatility. The fiscal and the monetary challenges in Western economies haven't really been addressed in a detailed manner. To that extent, there will be a little bit of continued upheaval in markets. If I have to then judge how the markets are or how the rates are going to perform, I think over the next couple of months, the backdrop being easy liquidity and space for RBI for easing, we will have most likely a scenario where rates inch down across the curve, shorter end because of additional liquidity and longer end because of possible RBI OMO purchases. Talking about the funds that I manage, that is Tata Treasury Advantage to start with. It's a low duration fund which keeps the duration between 0.5 to 1. Given that liquidity is going to be easy, it is going to be an accrual market going forward for next couple of months, and one should look at a duration of close to half a year to 1 year because the curve is steep. So if you're talking about an overnight rate of close to 5.25% and a YTM which is more than 125, 150 basis higher than that, I think unless and until you are risking a rate hike, which I don't see as a scenario, it's just on the table for taking. So on the Gilt Securities Fund, that fund is more like a duration fund, long duration fund. Currently we are positioned at higher end of the duration curve with more than benchmark allocation towards longer dated papers, that is 30 year, 40 year, 50 year. The reason is simple. I think the steepness in the curve from 10 year cross 30 or 10 year cross 40 is extremely high, and as it is, the yield spread between repo rate and the GSEC curve is very high. So if RBI has to continue doing OMOs, I think the entire yield curve will drift downwards. Also in September, government did recalibrate the borrowing calendar and reduce the supply at the longer end. I also handle the Tata Floating Rate Fund, wherein we are handling a portfolio of between 1 to 1.5 duration as of now. The idea is to continue maintain accruals. The way we handle or the way we manage the portfolio to become a floating rate is more by using swaps rather than pure floating rate instruments, because pure floating rate instruments are slightly illiquid as compared to normal bonds. So that's a bit on my funds. In near term, if you ask me what are the risks that I see, there are no major macroeconomic events that come to the fore for the near term. However, over a medium term, it's important that both fiscal and monetary policies in the West do address the challenges that those economies are facing. And geopolitical unrest or geopolitical situations across the world, if they have to subside, then it's always good for the financial markets. On that note, I would end today's talk. Wish you all a very happy new year and best wishes for investing for the next year.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.